Question 1. What is business finance? Answer. Business finance is a term that encompasses a wide range of activities and disciplines revolving around the management of money and other valuable assets. Business finance programs in universities familiarize students with accounting methodologies, investing strategies and effective debt management. Question 2. What are types of business finance? Answer. Business finance is available in multiple forms, including term loans, short-term loans, equipment financing, factoring, capital from angel investors and credit card loans. Question 3. What is small business financing? Answer. Small business financing, also referred to as startup financing or franchise financing, refers to the means by which an aspiring or current business owner obtains money to start a new small business, purchase an existing small business or bring money into an existing small business to finance current or future business. Question 4. What are financial instruments? Answer. Financial instruments are assets that can be traded. They can also be seen as packages of capital that may be traded. These assets can be cash, a contractual right to deliver or receive cash, or another type of financial instrument, or evidence of one's ownership of an entity. Question 5. What are the types of financial instruments? Answer. Types of financial instruments. Financial instruments may be divided into two types: cash instruments and derivative instruments. The values of cash instruments are directly influenced and determined by the markets. These can be securities that are easily transferable. Cash instruments may also be deposits and loans agreed upon by borrowers and lenders. The value and characteristics of derivative instruments are based on the vehicle's underlying components, such as assets, interest rates or indices. These can be over-the-counter (OTC) derivatives or exchange-traded derivatives. Question 6. What are asset classes? Answer. Financial instruments may also be divided according to asset class, which depends on whether they are debt-based or equity-based. Short-term debt-based financial instruments last for 1 year or less. Securities of this kind come in the form of T-bills and commercial paper. Cash of this kind can be deposits and certificates of deposit (CDs). Exchange-traded derivatives under short-term debt-based financial instruments can be short-term interest rate futures. OTC derivatives are forward rate agreements. Long-term debt-based financial instruments last for more than a year. Under securities, these are bonds. Cash equivalents are loans. Exchange-traded derivatives are bond futures and options on bond futures. OTC derivatives are interest rate swaps, interest rate caps and floor interest rate options, and exotic derivatives. Securities under equity-based financial instruments are stocks. Exchange-traded derivatives in this category include stock options and equity futures. The OTC derivatives are stock options and exotic derivatives. There are no securities under foreign exchange. Cash equivalents come in spot foreign exchange. Exchange-traded derivatives under foreign exchange are currency futures. OTC derivatives come in foreign exchange options, outright forwards and foreign exchange swaps. Question 7. What are the different class of shares? Answer. If a company has only one class of shares, they will be ordinary shares and will carry equal rights. Different classes of shares within a company can carry identical rights, but very often have different voting, dividend and/or capital rights. Question 8. What is the meaning of redeemable shares? Answer. Certain shares, usually preferred shares, are redeemable by its terms at a fixed date or at the option of either the corporation who issued the shares, the stockholder, or both at a given price. Investopedia explains that an issuing corporation may require employees to redeem shares based on predetermined timelines. Question 9. What is equity share? Answer. An equity share, commonly referred to as ordinary share, also represents the form of fractional or part ownership in which a shareholder, as a fractional owner, undertakes the maximum entrepreneurial risk associated with a business venture. The holders of such shares are members of the company and have voting rights. Question 10. What are preference shares? Answer. Preference shares, more commonly referred to as preferred stock, are shares of a company's stock with dividends that are paid out to shareholders before common stock dividends are issued. If the company enters bankruptcy, the shareholders with preferred stock are entitled to be paid from company assets first. Most preference shares have a fixed dividend, while common stocks generally do not. Preferred stock shareholders also typically do not hold any voting rights, but common shareholders usually do.